Ticker symbol Keys is down 4.5% in the past year, but today we'll be looking at a high quality company which I believe has a wide moat, and this is a highly profitable and consistent stock which has solid fundamentals, high efficiency ratios, and is in a sector where there is high innovation and unfortunately a lot of competition. But it means that this company is always one step ahead of the game. Today we'll be looking at Keysight Technologies, an R&D solutions company. And no, this is not a microwave. This is one of the devices that they actually invented for companies to test their offerings. So in their annual reports, they say that they help companies solve critical challenges in their development and commercialization of their products and services. And this company's revenue is derived primarily from solutions addressing R&D applications. So they get to a client which is willing to do some R&D and some quality inspections, and they call Keysight Technologies to help them with those solutions. They are located in over 100 countries, and they mainly participate with companies in the communications, aerospace, defense, automotive, energy, industrial, and semiconductor industries. So in all those industries where innovation is extremely necessary. They have a three-part growth strategy. The first one is to invest to deliver differentiated first-to-market solutions, where their objective is to invest every single year approximately 16% of their revenue to R&D. As this is very good, as it will help them stay one step ahead from their competition and become more innovative and provide more value to their customers, meaning that their customers will become more loyal and be more likely to hire them again. The second strategy is to grow the recurring revenue by increasing their software content in solutions. So one thing that this company does as well is, as part of their offering or a part of their solutions, offer some software which provides a subscription fee, and by getting more companies to actually get this software, they will increase their recurring revenue, which is something which every single company should aim for. And finally, they want to expand into attractive markets. So by expanding the portfolio of solutions and engaging sooner in customers' design and innovation life cycles. But this company gets extremely interesting when we look at their financial analysis. They have a return on capital employed of 16%, which is very solid, with an interest coverage ratio of 18 times, meaning that they won't have to worry about debt anytime soon. And then their cash conversion is almost at 100%, meaning that for every dollar that they generate in net income, they generate 98 cents in free cash flow. Then their profit margins of 64%, and they have very safe operating margins of 26%. The only worry is that Key's net income is down 16% year over year, and as you can see, the revenue, gross profit, and net income were actually uptrending up until April 2023 when the downtrend began. However, we have seen that their gross margin and the net margin have stayed pretty consistent over this time period. But this does raise a question whether their growth is unpredictable. This company is using leverage in order to grow at a faster rate. However, they're doing so responsibly, as they have a current ratio of 1.7 times and a debt to equity ratio just over 0.4, meaning that it is in a very safe debt position. Then their efficiency ratios, of course, do follow a bit their net income. However, it is very positive to consider the return on capital employed is sitting at around 28%. Now, when moving on to their fundamental analysis, they get a 7 out of 8 ticks, starting with a low liability risk, which we saw with their interest coverage ratio. Then they have a very solid balance sheet, which derives from them being able to pay all their short-term liabilities only with their current assets. Then they're very good at generating consistent cash flows, and of course they have share buyback programs, which is very positive for us investors. This company has very high pricing power, as they provide very specialized and unique services and provide some very custom products for their clients. They're able to provide a higher markup than any other company. Then they do have organic free cash flow growth. However, in 2023, they lacked organic revenue growth. Now, finally, the most important point of the slide, whether this company has an existing moat or a competitive advantage. I believe they do. They provide some of the best R&D solutions, and they're investing 16% of their annual revenue into R&D to create more helpful solutions, improve their offerings, and provide more value to their customers. And this shows just how committed they are to retaining a loyal base of customers, because the majority of their customers are actually recurring. If you are a company that is innovating a lot and releasing a lot of new products, and you need assistance from a company like Keysight Technologies, and you are very content with the solution and with the service that they provided the last time you actually hired them, chances are you will hire them again and become recurring revenue for the company. I believe that their growth potential can be divided into two different avenues, the first one being the chance of geographical expansion. However, this company is already in over 100 countries, meaning that it has kind of saturated this growth avenue and it has already exercised it correctly. However, I believe that the majority of the revenues still come from the US, so they could try and funnel a bit of their know-how into other areas and improve their focus over there. And finally, the new offering development, which by innovating into their 16% a year investment in internal R&D, they will be able to develop new offerings, especially as the one that they said where they want to develop more recurring revenue software licenses. This could be a huge growth avenue for them. Now, when looking at their valuation, their historic PE ratio for the past 4 years, they're right now sitting at around 28 PE ratio, which is right around average for the past 4 years. However, I believe that this, in terms of PE ratio, is a bit expensive due to their unpredictable growth. Now, when looking at it from a free cash flow yield standpoint, they yield a 4.4%, which is higher than the long-term inflation rate of 3%, indicating that this company may be at an attractive valuation. Now, in terms of risk and possible challenges, the main one I see is the worsening of the competitive landscape. However, it's only a 50% due to the fact that they're investing 16% of their revenues into R&D, and this will allow them to stay just one step ahead of their competition, provide more valuable insights, and be more innovative, which will allow the company to thrive, work better, and allow them to become more competitive. Now, in terms of regulation and performance, I don't see these being risks in the short term, as I don't see any possible upcoming regulation changes that will negatively affect the R&D solution provider, and they have been meeting performance objectives for a long time. The one risk that does actually kind of make me hesitant about this stock is the risk for an economic downturn or the cyclicality that this industry has, because historically companies actually do release a lot less products when there is an economic downturn, as they have less money to invest and they're more focused on cutting costs rather than investing in innovating and developing new products. Additionally, this is caused by the consumer actually spending less money in the economy and them having a smaller addressable market for their new product. So this means that in an economic downturn where companies are spending a lot less money on R&D since customers will buy less products, this company, Keysight Technologies, will be negatively affected by the situation. So before moving on to the investment conclusion, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this is a company that has a very strong moat, which provides consistent, predictable cash flows and has high return on capital employed, meaning that it knows how to create value for the investor. So I believe that this may be a great investment, but its unpredictable growth and its cyclicality is actually making me hesitant of investing in it. Anyways, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trader Republic or Trading 212.